All right, Chapter 14 is primarily bonds, long-term liabilities, and long-term notes payable. So capital structure is how businesses pay for their assets. I mean, even we as individuals know there's only two ways of buying something, and that is cash or credit. So capital structure is how do corporations structure the assets that they buy in order to maintain operations as well as expand their businesses through long-term assets. So a highly leveraged company is one that has lots of debt as opposed to stockholders' equity. So stockholders' equity is the corporation's equivalent to cash for us individual consumers. So it is a mix of the original capital that the stockholders placed into the business, as well as any new stock issues that are sold after the initial public offering, as well as profits that are left in the business in the form of retained earnings. So the debt side of it is a mixture of current liabilities and long-term liabilities. So the advantages is that debt is normally a lower cost of capital than equity. You haven't set interest rate on bonds or notes payable. What's the cost of capital with equity? If you go out and you finance an expansion or your initial startup phase by selling stock in the company that you created, what's your cost associated with that? It is all your future growth. What's the cost of that? There's a famous story in the early days of Facebook when they first took occupancy of their loft or wherever in San Francisco. They wanted a mural painted on a wall. So they went out and contracted with a street artist. You know, some people call them graffiti taggers, whatever. And he came in and he did that. And they paid him with shares of Facebook stock. Early in the growth of Facebook. Now, I've seen him interviewed on TV, and he sold his stock before Facebook went public, which he openly regrets, because he said, if I'd have held on to it, so the urban legend isn't quite as much as it, but it was tens of millions of dollars for a wall worth of value. So I caution you, if you ever have desires to do some entrepreneurial endeavor in the future, if you can avoid it, borrow the money. Don't sell stock. The other advantage is that when you borrow the money, you can deduct the cost of that borrowing against your tax return. Interest expense is deductible. Dividends are not. Okay? You don't give up voting rights, and I'll caution this. One of my first mentors, one of the first CFOs that I learned most of what I know about being a CFO from, a guy by the name of Mike Arp. He made a comment one time that if you borrow a little bit of money from a bank, you have a banker. But if you borrow a lot of money from a bank, you have a partner. Because they will be in your office monthly, if not weekly, trying to figure out what it is you're doing and to ensure that you're going to be able to repay their loan. And especially if you ever have the, which I hope you never do in your career, ever have the need to go refinance a troubled debt, Boy, oh boy, wait till you see the loan covenants that they'll sneak into that document. I mean, my word. You pretty much have to call them every morning and say, now I'm thinking about buying a little bit of inventory to sell. Is that okay? They really, really will put a very close scrutiny on your operations. So even though they don't technically have a seat on the board of directors and they don't technically have any shares of stock to vote, if you get leveraged enough, they're going to be watching you closely. All right, so bonds first. We'll talk about bonds and then we'll talk about non-interest bearing notes, which is the opposite of what we were doing in chapter 13 on investing in, selling something and receiving a non-interest bearing note. This chapter we're going to look at the journal entries from the opposite side and how to calculate interest expense rather than interest income that we were doing before. But the process is the same. So a bond is a formal security. It has printed on the face of it, and I've got some pictures here in a second that I'll show you of actual bonds. And I went out to eBay and I actually bought some specimens, they look like bonds, but they were never issued, and I've misplaced them. So I'm still searching, hoping to be able to bring them in and you can actually see the bond. But it has a face value. Normally they're in maybe $10,000 increments, something along those lines. Maybe $1,000 to $10,000. That's the par value. At some point in time, they're going to mature, which is important because bonds have two cash flow streams. One is they mature and they pay to the bondholders the face value of the bond. So if you go out and buy a $1,000 bond and it matures in 5 years' time, in 5 years' time you can send the bond back to the issuer and get your cash. All right? So that's one cash flow stream that we have to calculate the present value for.
So a bond is like a borrowed money from an investor?
From an issuer. And the issuers can be a corporation, they can be cities, states, all sorts of people, the federal government, treasury bonds. There's all sorts of people that issue bonds, both foreign and domestic. I mean, it's a lot of foreign corporations enter into the U.S. capital markets by issuing a bond issue. So it's very commonplace to see a corporation from Japan or South Korea or Canada issuing a bond. And then if they're well received, once they get an idea as to how the U.S. capital markets perceive the risk of their operation, they may then come in later and issue an equity offering. But quite commonly, it'll be a bond. Okay? Does that answer your question? Okay. The bond also has printed, all these first items here are printed on the face. It has a rate, an interest rate, that is going to pay you the second cash flow stream. Because periodically, and bonds typically pay semi-annual interest, periodically they're going to actually give you an interest check. So that's the second cash flow stream that we will use to calculate the price of a bond. All right? So these items are all printed on the face, and they're very ornate. They look very similar to a share of stock. So that's all on the bond certificate. The last one, well, it's not on here. The last one is a market rate. So the market on a daily basis is going to determine how much yield do they need from that particular bond. And they do so based upon how much risk is involved. Because by now, you must know that the higher the risk, the higher the yield, right? You're going to want more money from the city of Detroit than you want from San Antonio. Does that make sense? Because Detroit has defaulted on their bonds and they're in turmoil. San Antonio is relatively stable. I don't know what the credit rating is on San Antonio, but it's not bad. You're going to want more from Russian bonds right now than you want from U.S. bonds. And U.S. Treasuries are often referred to as zero risk. I mean, back in the 2008-2009 worldwide crash, investors from all over the world were dumping their money into U.S. Treasury notes just to have someplace safe to park their cash so they didn't lose any principal, to the point where the U.S. Treasury bonds had a negative yield. They were, in essence, paying the U.S. government just to hold on to their cash. They were losing money as a yield, but they weren't losing, there was no risk involved. So it was a very unusual circumstance, which I don't think in my lifetime I'm going to see again, but it did in fact happen. All right? So the higher the risk, the higher the yield. That is not going to necessarily match what the contract face rate is. Okay? Other characteristics of a bond debenture bonds are just based upon the credit worthiness of the issuer. They are not tied like a mortgage bond to a physical asset. Now, I don't know that Toyota floated a bond to build the Toyota plant on the southwest side of San Antonio, but if they had, that would have been a mortgage bond. The city of San Antonio issues, UIW, the campus you're sitting in, we issue debenture bonds. We finance a lot of our expansion, the new fine arts building, what they're going to start on the new Marion Hall. You all are aware they're going to tear down Marion Hall starting in a few months. Do you know where you're going to eat afterwards? The ICC. Yeah, we're going to have to go up the hill to get lunch. So either that or Chick-fil-A is going to get really busy. So anyway, and it's going to take 18 months. But boy, when it's done, it's going to be magnificent. I've seen some of the renderings of it. It's going to be really nice. But it's going to be heck getting it from there. So we issue debenture bonds. It's just based on the general credit worthiness of the university. All right? So that's a difference. We'll talk about zero discount. You very rarely see these. Callable bonds. Investors aren't real enamored with callable bonds because the issuer, whether it's the corporation or a city or a municipality or even a university, gets to recall those bonds and cash them out before the maturity date if the interest rate becomes favorable to the issuer, not to the investor. So in other words, if I have issued some 5% bonds and the current market rate starts dropping down to 3%, I can call all those back, cash out those bondholders, and then reissue a new set of bonds at 3% and save some cash. So investors they're savvy enough that they build that into their yields. They typically want more because it's higher risk. They may lose their high interest rates. Convertible bonds we'll talk about quite a bit when we get to earnings per share here in a couple of chapters, if not next. Convertible bonds are ones that you can convert to shares of stock. So it has an equity component. So right now, you get the interest income, but if you want, and it's to your advantage, you can convert those into so many shares, a predetermined so many shares of equity. And then serial bonds, you also don't see many of these, but it's a single bond issue. We're going to raise $1 million, and we're going to do them in really 4 maturity dates. So we issue $1 million, but 250 of it is going to mature in 5 years, another $250,000 matures in 10 years, and another $250,000 in 15, and then the last $250,000. It just helps spread out the cash flow burden to the issuer, so that they can pay it back in installments rather than in one lump sum. All right, so here's a good example, or a example. I don't know how good it is. This is a $1,000 bond. It was issued by the state of South Carolina a long time ago. It's the maturity date was the 1st of July, 1893. Somewhere on here it says what interest rate it pays, but I can't. Oh, here, 6% per annum is what it says here. And so that's what it looks like. Here's another example that, and granted, it's from the Commonwealth of Australia. It's paying 5.25%. It's only a $20 bond, but it matures on the 15th day of November, 1987. And so it was issued on 66. So it's an 87, you can see here, that's the maturity date. But what I wanted you to show you here is these are coupons. Bonds now are electronically registered to the bondholder, just like shares of stock. So Boeing Corporation that I own stock in knows that I'm a shareholder. They send me proxy statements and annual reports and stuff like that because I'm a registered holder of equity shares. It's the same with bonds. If you're the registered holder, when the interest payment comes up, you will get the interest payment, just like I get dividends, automatically to my account. All right? So when Boeing issues a dividend, I don't even think about it. It just shows up in my investment account. All right? Same with bondholders now. They automatically get the interest. That was not the case 15, 20 years ago. Bonds used to be bearer bonds. Whoever physically had possession of the bonds owned them, just like cash. So you would see on typically the last day of June and the last day of December or the week before, all the little blue-haired ladies going to the bank. And they would go to the safety deposit box, and they would open up the safety deposit box and take out their stacks and stacks of bearer bonds with a pair of scissors. And they would sit there and clip out these little coupons. And either take them to a payable office or address the back of it and mail them off, and then they would get their checks. But we don't do that anymore, so you rarely see coupon bonds anymore. Because it's not necessary. It's all electronic. All right? But I wanted to show you what that looked like. This was a whopping 52 cents. If you clipped that little coupon out and mailed it to the Commonwealth of Australia. Here's another bond. This is a $100,000 note in United States Steel Corporation. It was issued to Andrew Carnegie, who is the individual who started it. It pays semi-annual interest on the first day of January and July in the amount of something. There's an interest rate on there somewhere. And so this gives you an idea what bonds look like. And so they're in various values, face values.
So you say Andrew Carnegie was
He was the founder of U.S. Steel,
so
yeah.
Is it him?
He's borrowing his own company. He's borrowing money to his own company. Yes, very, very common. Even in privately held or closely held corporations, you commonly see shareholder loans. You know, they don't want to put more capital in, but they want to get some sort of cash flow stream out of the companies that they own in the form of interest income. Okay? All right. So, how do we issue bonds? Well, it's a security just like an IPO. So you got to go through all the steps of registering with the SEC. Because if you're selling a bond, just a bond, you are a registered entity. And you have to comply with all of the annual reporting and quarterly reporting and all of the reporting requirements that publicly traded corporations have to do. You got to file all that stuff with the Securities and Exchange Commission. Set the terms of the bond. How much are we trying to raise? When will it mature? How often will we pay interest? At what rate are we going to print on the bond certificate? Okay? print up the actual certificates, make announcements. Oftentimes you'll get an underwriter, maybe a Merrill Lynch, something like that, to help you market these bonds. And then the selling price is going to be dependent upon the market on the day that you actually set these available for sale. So, the yield is the market rate, and it varies day in and day out depending upon the market's acceptable level of risk for a similar type security that you are offering. So what will happen? Either you, when you got your board of directors together and you set the face rate on this issue, this bond, you have guessed correctly. The best scenario. You have guessed the market rate. You've paid 8% and that's what they wanted. At which point they will buy it at par. They will give you exactly what you want. If you're selling $1 million worth of bonds, it'll sell for a price of 100. Because when you look at bond prices in the Wall Street Journal marketplace, go to the page for bonds, you'll see they're a number a little bit above or a little bit below 100. It's a percentage. And you multiply that by whatever the face rate is of the bond, whether it's 5,000 or 1,000 or 100 or 100,000 in the case of Carnegie. Whatever the bond face rate is, you multiply it by the price, and that's what you actually pay. So if it sells at par, it's a price of 100. Does that make sense? And that's because you gave the market exactly what it wanted. The two rates equal. If you don't give it to them, the market needs 9% and you're only giving them 8. They will penalize you because you're not giving them enough cash interest for them to be able to make this investment. At that point, the bond will sell for less than 100 and it will be a discount. So they'll get a $1,000 bond for $995, let's say, and that extra $5 will increase their overall yield up to where it needs to be at 9%. I'm seeing a couple of furrowed brows. Did I lose people on that one? Yes.
Does the stated rate or whatnot, does that depend on the person you're getting the bond from? Or is
That's the bond issuer. You went to your board of directors and you said, listen, we're going to go raise $1 million in bonds. We believe, we the finance department and treasury and all that, believe that the market will accept an 8% face rate. So for $1 million, if we pay them $80,000 a year in interest, we'll be fine. But it's a guess.
Yeah, so
I'm just making an estimate.
if you have like another bond that you're gonna like issue, is that gonna be another? That's gonna be different.
Different. That'll take a different board of directors meetings, a different approval. You'll print up a different certificate. More than likely, you'll have a different maturity date. We'll have a different face rate, interest. Do you have a question?
So, if the interest rate is lower than what it should be, wouldn't it be selling at a higher price?
No, if the market wants more than what you're paying. So you're only paying them 8%, but they want 9%. So they'll make up the difference by giving you less than the face rate because they're penalizing you because you're not giving them the $95,000 a year that they want. You're only giving them $80,000 a year. Okay? Does that make sense? So if the market rate is higher than the face rate, it sells at a discount. The opposite is true. If the market only needs 7% and you in your infinite generosity are giving them 8%, they'll reward you. Because they only wanted $70,000 a year on that $1 million and you gave them 80. So they'll give you more than, it'll sell at higher than 100. And we'll determine here in a second exactly how much more and how you calculate that. All right, does everybody understand that basic premise? It's either going to sell at par, at a discount, or a premium. All right, let's go to an example. $100,000, 5-year bond. It has a face rate of 12% semi-annually. All right, so it's paying $12,000 a year in interest, but it's paying them in 2 equal installments. So over the 5-year life of this bond, you're going to get 10 checks of $6,000 each. The market on that day wants 12%, so it matches. So it's going to sell for exactly $100,000. How do you prove that? Well, you go to the tables. These things. By now, you've all found this, right? It's at the end, it's in between chapter 5 and chapter 6 in your textbook. It's a series of factors, percentages across the top, and a series of periods for how long that you want to discount back to the present value. All right? So if you go, this is a 12% bond. So what column are we going to use? And I'll give you a hint. It's not 12%. Don't say 12. 6% because it's semi-annual. So 6% is I. So you're going to go to the 6% column. What's N? It's not 5. Because how many payments are you getting? 10. You're getting 10 payments. It's semi-annual. Okay, so if you go to the 6% column, and we'll start with 4, because there's 2 cash flows, remember? There's the maturity, that is a single payment of $1 sometime in the future, and there's the $6,000 that you're going to receive every 6 months as an interest check. All right? So if you go to 6%, and this is the table 4, an ordinary annuity. So this is a multiple cash flow stream of the same amount over a period of time. Go down to row 10 and you'll get 7.360087. All right? That's this one. $6,000 times 7.360087. Go to table number 3, which is the present value of $1. Now, has everybody realized by now that table 4 is merely a summation of table 3? Apparently not. All table 4 is adding up these factors. Because what is this annuity is $6,000 over the next 5 years, paid twice. Well, you're going to get one in one period, 6 months from now. That $6,000 is worth 90.943396, right? Yes? And then you're going to get another one, another 6 months from now. That one is today worth this, and so forth and so on and so on. So if you just look at these two, if you just add those two together, that's what this factor is. Because look at table 4. There's that same number, 0.943396. And then if you add that next line down, that's the 1.833393. So that's all they're doing in this table. We'll talk about it on Thursday when we start doing problems, because table number 5, and I just want to just let that note be known now, okay? Remember this factor, this 0.943396. The only thing table 5 is an annuity due. What an annuity do is that it's a series of the same dollar amount over a period of time, only the first payment is being received today, not one period from now. So in other words, if you go and you buy a piece of machinery and you're going to pay $10,000 over 12 payments for $120,000, but you're making the first one today, you're putting $12,000 or $10,000 down. That's an annuity due, because look at the present value for 1 in table 5. It's 1, because what's a dollar worth today? It's worth $1. And then look at a year from now. There's that 0.943396. Because if it was only 2, give me 10,000 now and 10,000 a year from now, that's what it is. So that's all table 5 is doing, is adding up those same factors in table 4, but starting with a factor of 1. Okay? All right, so let's go to table number 3 and get that payment. All right, so under 6, down to row 10, that's 0.558395. 0.558395 times the principal. Add those two together, and what are you going to get? Drum roll. Well, it's selling at par, so you're going to get exactly 100,000. All right? Now, what rate did we go to the tables to look up? The face rate or the market rate? Nope. In the table, we only used 1. And this is important because this is the mistake you're going to make on the midterm. You're going to go look the face rate up in the tables, and you need to use the market rate, because that's the yield. That's what you need to discount back to the present value, is the yield, not the cash. The cash is just what's being paid every 6 months. All right? So if you make that mistake, what will happen to your calculation? If it's a $100,000 bond that I'm asking you to calculate, what number will you get? You'll get 100,000. I'm not going to give you a par value on the midterm. All right? So if you get a calculation, you've used the wrong rate. Go use the other rate and redo it. Because I'm going to give you either a premium or a discount. I'm not going to ask you to calculate par, because what would be the fun in that? Right? Because you would read the problem and go, oh, I can tell you it's 100,000. Done. Easy. All right? So I'm not going to do that. So use the market rate when looking up factors in the table. And actually, I don't require you to bring the tables in. I'll give you the factors, but I'm going to give you both. I'm going to give you, in this case, I would give you the 12% factor, the 6% factor, and I'll give you the factor for 5 years and for 10 years. So you need to know which one to use. All right, so that's that one. What if the effective interest rate was 14%? So the market needs 14, you're only paying them 12. What are they going to do to you? Without reading that word there, because you can see it on. They're going to penalize you by giving you less than par value. Same, go to table number 3, look up the factor now under the 7% column, because it's a 14% market rate. Down to row 10, you get 508394. Go to table 4, repeat the process, you get 7.20235. And sure enough, not 100,000. The market only pays you $92,976.39.
So would you subtract that from the 100,000?
And that would be the discount on notes payable that would be your debit. Because what is the entry for this issuance? It's going to debit cash for $92,976.39. You're going to credit notes payable for $100,000. and then the balancing entry is a debit to discount on notes payable for the, I don't know, 7,000 whatever that you need to make up the difference. Okay? Yeah, $7,023.61. What if the market only needed 10%? Then they're going to give you a premium. So multiply out those factors, you now have a selling price of $107,721.71. So that's going to be your your debit to cash, $107,721.71. You're going to credit notes payable for $100,000 because that's the face value, the maturity value of the bond. And then premium on notes payable is also a credit for the $7,721.71. So that's how bonds work at the date of issuance. Now what do you have to do between you issuing the bond and you maturing the bond in 5 years in this case? You have to calculate the interest. And the way you do that is the effective interest rate method. So on the discount, where we've got a book value of $92,976.39, we're paying cash every 6 months of $6,000 for 10 payments over the next 5 years. What is the interest expense? It's more because the market wanted how much? They wanted 14%. We're only giving them 12. So if you multiply the $92,976.39 times what? So if it was 14% effective yield, what interest? 7%. 7%, you'll get $6,508.35. That's a difference of $508. And you always know, because what's the end objective? Whether it's a premium or a discount, at the end of the 5-year period, the whole bond has to have a book value of $100,000. So in this case, you need to add to it each 6 months. Because that's the only way you get from 92 to 100. You got to increase it. Now you've got a book value of 93. Multiply that by 7%, $6,543, an amortization of $543.93. Okay?
If it's a premium, will it be subtracting down to the face value?
Yes. I didn't have a premium. I don't know why. But I'll do a premium on Thursday. Yeah. I'll do both on Thursday. But yes, that's exactly, because you have to get to the face value. So whatever it takes, just think it logically through. Don't add to it, because that's going the wrong direction. You need to decrease it from that 107 that we had on the selling price of the premium when the market only needed 10%. And then what are you going to multiply times the face value? 5%. Okay? We're good on bonds. How to calculate the sale price and how to calculate the interest expense. Because that's really the only two things that you ever need to do with a bond. With a simple bond, not a callable or...
So it's always going to be effective interest method, right?
That's what we use. That's what we're going to teach in here. There is a straight line method that is acceptable under U.S. GAAP. You can just take that and divide it by 10, but there's no sense in teaching you that. That's too simple. Yeah. So I'm assuming you can all take the discount or the premium and divide it by 10. And that would be the same interest expense every period. You get to the same answer at the end, but this one is the most common to use. All right? All right, long-term notes payable. Just like when we were purchasing or selling an item like land or building on your wonderful little homework problem, we also issue. We'll buy items by issuing a non-interest-bearing note. U.S. GAAP requires, just like we were required to impute interest income on the receipt of a non-interest-bearing note, we're required to impute interest expense on the issuance of a non-interest-bearing note. And the methodology is the same. If we know the fair market value of the item that we're buying a building that we have a survey on, a real estate appraisal on. We're buying a piece of machinery, God bless you. We're buying a piece of machinery that has a list price. If we're able to buy that by issuing a non-interest-bearing note at an arm's length transaction with an unrelated vendor, then the present value of that note must be the list price of whatever we're buying, because otherwise nobody would take the deal. Okay? So in those cases, you take the list price of what we're buying, divide it by the face value of the note, and get a factor. Go to the tables, whether it's an annuity where we're going to be making periodic payments, or it's a single payment at some point in the future. Go to the tables, look down to N, depending upon how long the note is outstanding, over to the column where you find the factor, and that is the implied interest. Okay? So, the imputed interest rates. All right, so we issue a 3-year non-interest-bearing note with a face value of $8,000, and we receive a piece of machinery that has a list price of $5,694.24. What's the interest rate? You just, well, here's the entry. Well, in this case, we're receiving cash, but it could easily just say machinery. The discount on bonds payable and the notes payable, and so the imputed interest rate is divide the one by the other. So if you divide 5694.24 by 8,000, you get a factor of 0.71178. N is equal to 3. So we just go to table number 3, and 177. Go to table number 3, on 3, and we look across. It's not 7%. It's got to be higher than that. Go across, and there it is. 0.71178. It's a 12% note. So the interest at the end of year 1, interest expense is going to be the net proceeds of $5,694.24. That's the book value of the note payable less the discount, times 12, that's $683.31. Add that to the $56.94, and you now have a book value of $6,377.55. Multiply that by 12%. Interest expense for this second year is $765.31. That's the debit, and the credit is the discount on notes payable.
Is this being done all like at the end of the year? Like
End of the year when you need to accrue the interest expense, yeah. In reality, most corporations are going to do it monthly, because otherwise you've got no interest expense month after month after month, and then in December you got a whole bunch of it, so that drives managers crazy. What happened? Why did we lose so much money in December? Well, I charged you all the whole year's worth of interest. They don't like that, trust me. So you would probably do this. Just like depreciation, when we calculate depreciation, we've always been doing it annually, but in reality you do it monthly. So, okay? All right? We're good on this one? So there's your interest expense, and then your new book value is the increase because you've whittled away a piece of that discount. All right. Notes are used for a variety of things. So if there is no interest stated or it's unreasonable, then you go to the fair market value of the good or service Otherwise, if you don't have a value, just like when we did the homework problem on the note receivable, and we did not have a value on the, was it the machinery? Yes, the machinery. No, we didn't have, on the land, we didn't have a value on the land, so it gave us a 12% interest rate. And so we used that to calculate the discount. So you have to know one or the other. You have to know either the fair market value of the transaction or the stated interest rate on similar borrowings. It's the only two ways you can do it. Okay? $10,000 5-year note in exchange for some used equipment. Similar incremental borrowing rates is 12%, so we go to table number 3, go to 12% column, down to row 5, and we get a factor of 0.567427. So the transaction is going to be a debit to machinery or equipment for $5,674.27. A debit to the discount on notes payable for the difference. I don't know if they got it here. Yeah, the discount on notes payable for $4,325, and a credit to notes payable. All right? So if you don't know the fair value of the transaction, there's no list price on the equipment, or there isn't a real estate appraisal on the building that you're buying, then you do it this way. Okay? And then amortize that by using the effective interest rate. So you take the $5,674.27, multiply it by 12%. At the end of the first year, you get $680.91 in interest expense. Credit the discount, lowering that contra liability account by that same amount. And then the following year, you now have a new book value, which is the $5,674 plus the $680, and so your interest expense goes up, and you do that throughout the 5-year period. Okay? Lots of problems on Thursday. Don't go anywhere because I want to solve the confusion of problem 1321. I don't know why there was so much confusion.